Hi, guys. Welcome to the live stream this Sunday morning for me, or Sunday afternoon, wherever you are. We're going to dive into the questions right away. I've got Sebastian right here on my phone. If you guys have a question, you want to make sure I see it, I will answer it to the best of my ability. Do a super chat, and Sebastian will text it right over to me. If you have a question for the live chat, make sure you start with question in capital letters. I've got to get to an interview with my buddy Eric Townsend from Macro Voices. I'm interviewing him in about an hour. So Sebastian, we've only got about 45 minutes for this one, buddy. So we've got to stop the super chats no later than maybe 12:20 Eastern time, 11:20 our time. So we got to be cognizant of that first and foremost. Some housekeeping, guys. If you're interested, I interviewed Marin KATUSA. If you're a precious metals person, investor, or interested in commodities, I highly suggest watching that video and the video I did Friday on swap lines, because Marin brings up some very interesting points that I think we as investors need to be cognizant of when we're analyzing the risk in our portfolio. And check that out. We're also doing a week-long promo with Marin. We typically do that when he comes on the show. So if you're interested, we'll put a link in the description of this video. You can check that out. It's a great way to support the channel and get some awesome research if you've thought about subscribing to his newsletter in the past. One thing I want to mention regarding that is, I know a lot of people have mentioned that they're either they're subscribing to one newsletter or the other, and I think sometimes people could be subscribing to these newsletters for the wrong reasons. And I'm not going to say the wrong reasons. Let me tell you why I read newsletters, and maybe that can add some value. I don't read a newsletter to get hot picks. Like, I don't go through the newsletter, any newsletter, I don't care what it is, and say, okay, what is this guy or gal suggesting? Oh, they're suggesting Tesla, or they're suggesting this oil company. I got to rush out and buy that. Yeah, I'm going to do that. That's a hot pick, and I'm going to get rich if I invest in their tip. I don't look at them that way at all. In fact, I almost ignore the specific companies that they reference in the newsletter. What I do is I use them as kind of a tool to outsource my own research, because I don't have time to do it myself. I see them as an employee. So if I was going to hire a research analyst, I wouldn't hire that research analyst to give me stock picks. I'd say, listen, research analyst, I want you to study what's going on right now with the oil market, and I want you to report back to me. And then hopefully, if they're a good research analyst, they give me all the data I need. But then I take and I absorb that data. I think about it. I process it. And then I come to my own conclusion on what I'm going to do and which company I'm going to invest in. And whether it's any research letter, I read Chris's and Marin's, but I think any research letter, it doesn't matter. I would look at it the exact same way. I'd look at it as an employee that I just hired to do research for me on specific topics. I wouldn't look at them as some sort of master guru that just anything that comes out of their mouth is gospel, and I need to act on it immediately. I'm not going to tell you what to do, but that's just the way I see things for myself and my own investments, and maybe you can get some value out of it. So anyway, if you're interested, we'll put a link in the description below. So I know looks like we got a ton of super chats here, guys. Oh, and one other thing too, I wanted to mention. This week, I'm going to be on Rich Dad Radio with Robert Kiyosaki. I'm really looking forward to that. So if you guys or if you listen to that podcast or tune into his radio show, make sure that you kind of listen for when I'm going to be on if you want to hear me talking to Robert. And I'm going to interview Robert on Monday, so we'll most likely upload that this week. But Tuesday night is the big night. Tuesday, write it in your calendar right now, 9 p.m. Eastern time. I'm going to upload the interview I did last week with Jim Rogers. And I can tell you guys, it was fantastic. It was so awesome. I cannot wait to upload it. You guys are going to love it. And I know the knock against Jim is that sometimes he's very broad. He just kind of says the same things over and over again. But quite frankly, guys, I think that has a lot to do with the person actually interviewing him, because I mean, not to toot my own horn or anything, but I know a lot about Jim Rogers, and I have read his books, and he's my favorite investor. And so I go way back with Jim on our interview. We go back to the 1960s to the 1970s. I bring up trades that I know Jim made in the late 80s, in the early 80s. I know he shorted the Japanese market in the late 80s, and he wrote it all the way down. And I talked to him about those specific trades and his mentality. I try to get into his framework and what was going through his mind that prompted him to either short the Japanese market or go long the German market at a different date and time. And even I take it more recently with his investments in Russia and Zimbabwe. I don't just say, Jim, what are you investing in? I go deeper and try to find out why. When you're looking at it from a tops down approach, what were you looking at? Were you looking at the demographics of Zimbabwe? Were you looking at the natural resources, the debt to GDP? And then what was your catalyst and how? And then we start talking about, he used to teach at Columbia University, for those of you who didn't know that. So we go into the classes that he taught at Columbia and how he used to teach his own students to be better investors. We go into that and we pick it apart so you guys can take this interview and just take your investing to the next level, courtesy of Jim Rogers and his years and years and years of experience. So anyway, you guys are going to, I got to get into this or I'm never going to get to my interview with Eric Townsend. I'm just so excited about that interview. Man, I can't wait for you guys to see it. You guys are going to love it. Okay, let's go to the super chats here. Chad, he says Kiyosaki dislikes the Fed. Please ask him who owns the Fed. Oh boy, I got to write that down, Chad. I know you've asked me to do that a couple times, buddy. I'll do my best to remember. I interview Robert on Monday, and I go on his show on Wednesday. But as far as when I upload the interview with Robert or when he uploads my interview, I don't know. But I'll do my best to remember. Dapper Dave, thanks for the super chat. One of the most important questions asked yesterday was about BRK buying out money if there is negative interest rates. I don't understand the concept. Question asked yesterday was about BRK paying out money if there was negative interest rates. I'm not sure what you're referring to exactly there, Dapper Dave. Can you don't do another super chat, but I need you to somehow clarify exactly what you're talking about so I can better answer this question. All right, if you're in the live chat right now, Dapper Dave, can you just clarify? And Sebastian, look out for that. And then just send me a quick text and we'll circle back to this question at the end. because I know you're talking about a ticker there. Let me try to, I've never done this before, but let me go on my computer while I'm doing the live stream. Oh, you're talking about Berkshire. Okay, so you're talking about Berkshire Hathaway. So let me go back to your question here. One of the most important questions asked yesterday was about Berkshire paying out money if there was negative interest rates. I would have to, are you talking about their insurance companies? Because that could really have an impact on insurance companies. I'm not exactly sure what you're referring to, or maybe if you can put a link to the specific interview. I'm assuming you're talking about a Buffett interview or maybe a call he did with CNBC. But let's circle back to this at the end. Great question. Andrew, thank you for the super chat. How will deflation impact gold mining stocks? This is such a tough question because Andrew, it seems like you're looking at deflation and inflation as just kind of this monolith. And you either have one or the other. Either all prices go down, all asset prices, consumer prices, everything goes down at the same time and the dollar goes up, or all prices, asset prices, consumer prices, oil, commodities, everything goes up at the same time while the dollar goes down against foreign currencies. It doesn't work that way. It just doesn't work that way. If you go back to the video I did, I believe it was Monday, and I outline how inflation worked over the last 20 years. So I've got a chart with a few different data points on it. One was the CPI for the United States, which pretty much just goes straight up from left to right. It's got a little bit of a blip down in 2008 or 9, but then just comes right back. And then I compare that to the DXY, which goes up and down and up and down. And then I compare that to asset prices like the S&P, which, as you know, in early 2000s goes down, comes back up, goes down, then comes back up. And then housing prices, which peaks out in 2006, goes down to a low in 2012. And you see there's very little correlation with the CPI and the dollar on the DXY, very little correlation with asset prices. They can all go different directions. So when you're talking about deflation, as Lacey Hunt might, with the most recent interview he did with Eric, which was fantastic, great interview. Lacey Hunt's looking at it from a standpoint of debt. So if you get to a certain point, your income, whether you're an individual, a corporation, or a country, your income has to pay the debt, the interest plus principal. And if your debt exceeds that income to a certain degree, then you can't take on more debt, can't spend more, and then your GDP growth or your personal consumption is going to deteriorate substantially, therefore deflation. But that's really a debt deflation. And so in that type of environment that we have a debt deflation, what prices go up and what prices go down? The price of everything does not go down. I can almost assure you that the burrito you get at Chipotle, if we have deflation, that burrito will not go down in price. I can almost assure you. I can almost assure you that the price of your kid's college tuition is not going to go down. The cost of your health care is not going to go down. Although the CPI might go -1 or 2, to Dr. Hunt's point. So it's a very, very nuanced question. But let's look at it from the standpoint of what I would personally look at with the mining stocks is I would look at deflation relative to the cost of energy, because that's a big input for them as far as their expenses. So with oil down, call it $20 a barrel or $30 a barrel, that's going to most likely benefit gold miners substantially, assuming that the price of gold stays high or continues to go higher, which it could. It's very possible in deflation for gold to actually go up in price in nominal terms. So I think that might be your question, Andrew, and that's how I'd answer it. I think that deflation, assuming you're talking about energy deflation, would be very good for gold miners. I'm not saying that it'll shoot their price a lot higher, but it's definitely a tailwind. Andres, thank you for the super chat. Hi, George. What are your thoughts on the Colombian situation? Hyperinflation risk? Any other risk? How would you protect your wealth in emerging countries? What I would suggest is looking at how people who are a lot smarter than I am have protected their wealth in South American countries and emerging markets for the last 1,000 years. And usually it's real estate. It can be gold, it can be fine art as well. But especially in South America, they are all about real estate. They really don't have savings accounts. They don't like to buy bonds for obvious reasons, because whether it's Colombia, whether it's Venezuela, Argentina, Brazil, they've almost, Ecuador, same thing. They've all had problems at one point in time with their currency. So if you're someone who's worth 10 million bucks and you're Argentinian, are you gonna have your money cash in the bank on Argentinian bonds? No way. No way. You're gonna have it in real estate, most likely, or a productive business. So that's kind of the safety play from what I've seen in my world travels for people who have substantial resources to protect their purchasing power. And what you'll see, or what I've seen in the past, is when a country really starts to get bad, actually real estate prices go up in real terms. In like Venezuela is an example of that. Now, I know recently, of course, prices have gone down substantially because the whole economy's collapsed. But when they first started having their problems with hyperinflation, you saw it was, and I thought real estate would be cheap. And I actually looked into it. This was maybe, I don't know, 5-6 years ago, something like that. And I saw that real estate was actually expensive because everybody was taking their money and buying any type of hard asset they could get their hands on. So I don't really worry too much about losing purchasing power in these types of countries, as long as I have my portfolio allocated to hard assets. If I had cash, if I had bonds, it would be a different story. Let me make sure I answered your question well. See, hyperinflation, any other risks? Oh, any other risks? Well, there's always political risks, but you're going to have political risks in the United States. I mean, that I think Americans have potentially I'm not going to say the biggest, but I'm going to say Americans have extreme political risk right now from the standpoint of taxes. What do you think is going to happen? I mean, 2020 comes along, the election. And I'm not saying I like Donald Trump at all. I dislike all politicians. You guys know that well. But if he doesn't get reelected, what's going to happen to taxes? And even if he does get reelected, what's going to happen to your purchasing power in the form of consumer price inflation when Trump, my goodness gracious, he spends like a drunken sailor. He's the biggest Keynesian of them all. Trump, he's more Keynesian than the liberals, for heaven's sakes. So but my point is, when you have these states that their pension fund is going bust, we go into potentially a recession or a depression, and the tax revenues go down to fund those pensions. I mean, they're going to raise property taxes. They're going to throw in a sales tax or a VAT type of tax, it's going to get very desperate in the United States. Even if we go into a recession where they're going to look at the people with the resources. And even if you're just a normal average Joe and you happen to own your own house, even if you don't own it outright, they're going to look at you and say, hey, we can milk this guy or gal, and we can pick their pocket. We're going to increase their taxes. So that's the big political risk that I see right now in the United States. But you have that in any country, and I think you have to size that up. And that's why I think you should diversify your political risk as well as your currency risk. You know, I've got a lot of assets in Colombia, but I've got a lot of assets in the United States. I've got some in Ecuador. I try to go all over the world, and if I find a place that I enjoy spending time and I think there's some upside, I'll try to put some money at work there. I've got money to work in Cyprus right now, for heaven's sakes. So it's just trying to spread your risk, because you never know what's going to happen. Free Thinker, thank you for the super chat. Getting macro fatigue. No, that's impossible. Not me. Maybe you are a free thinker. I'm not. I love this stuff. I could just go on and on and on. Too many different views on timelines, policies, triggers for inflation, deflation. How about metals, crypto, real estate, cash, even the split? All right. So I'm not sure if you've got a, let's see, cash, even, split. I'm not sure if you've got a question, free thinker, if you're just trying to vent some frustration. But I totally get what you're saying. You watch Macro Voices, Real Vision, CNBC, my channel, and you gotta, it's like a fire hose for sure. I like it because I just love this puzzle that you're always trying to kind of figure out. But I would suggest watching that interview with Jim Rogers, because he's got a way of just really taking things down to the basics and making things simple, understand, and really just going over what you need to focus on, and just realize that everything else outside of that is just noise. It's just noise, because at the end of the day, all we're trying to do is just buy things when they're cheap and sell them when they're expensive. That's it. Everything else is just noise. And although I enjoy the macro stuff and trying to figure out the pieces of the puzzle from a standpoint of investing, I don't know if you should consider all of it at all times, because you just get the paralysis of analysis. But if you're able to just focus on the key ingredients and what you should be paying attention to, I think that's what you need to do if you're looking at it from an investing standpoint. Andres, thank you for the super chat. And Sebastian, we should probably stop the super chats now, buddy. So, oh, geez. Yeah, we definitely stop the super chats. Yikes. I'm going to have to get through here quickly. All right. Sorry, guys, but I've just got a hard deadline with Eric. So let me try to. Andres, thank you for the super chat question. I live in Panama. We use dollars, and we don't have a central bank. How will countries that use dollars be affected by money printing in the U.S.? The problem is you've got to take on the interest rate policies of the United States. And if they allow inflation to run hot, just let's hypothetically say they do, it's going to affect your asset prices and potentially create bubbles in Panama, just like it's created bubbles in Hong Kong with their real estate. Because, see, so you've got two different economies. Let's say one, the United States is going down, so they're going to drop interest rates. But let's say you've got another economy like Panama that happens to be kind of okay, or at least they're even going up. Normally, you'd want interest rates in Panama, let's say 5 or 6%. But if the United States drops interest rates down to 0%, your interest rates are going to go down as well. So it can lead to inflation, bubbles, and the economy overheating. That's your downside there. The takeaways, the downside is you generally have to or end up adopting the same type of interest rate policy as the government or economy whose currency you're using. Eric, thank you for the super chat. What is your thoughts on franchises as investments, especially in these times? Have you looked into investing in some? What types? Yeah, I've looked at McDonald's and there's a few others back in my entrepreneurial days. I think I looked at some gas stations like Circle K's. I know there's a few others that I'm forgetting. But Eric, I think it depends on your personality. If you're someone who really is able to kind of follow a system, and if you're given like if you're a great student, and that's kind of the hallmark in my mind of a great student, is you're able to, you can take instructions and you can follow those instructions, and you the net result is very good. So if you're a type of person like that, I think franchises can be amazing because they're proven. You've got a system. Although, there's a lot of franchises though that where the franchisees don't make much money. It's where the franchisor, and it's a way for them to lend you money to own your real estate. So you really got to be careful with how they make their money in the system the franchise uses. But assuming that you've done your due diligence, franchises can be a great thing as long as you're one of those people that just like to take a template and execute on that template. If you're someone like me, it's a complete disaster. It's a total disaster. And that's why I never got into being a franchisee, because I was actually a licensee. I licensed my one of my businesses to other individuals. So I was like the franchisor in a sense. This was way back in the day. But I was never on the other side of that. And the reason, going back to my personality, is because I don't like taking directions from anybody. I don't like anybody telling me what to do. If you say cups should be red and I think they should be blue, I'm going to make them blue. And I know that if I just got into a situation with a franchisor, it would be nothing but the two of us just butting heads constantly. And it just wouldn't be good for either party. So I know myself well enough to shy away from those types of opportunities. Although for some people, they can be fantastic. Just depends on your personality. Silvio, thank you for the super chat. Hi, George. Many of us appreciate your effort in explaining all these macroeconomics in a very easy, digestible, enjoyable manner. Thank you. And I've got to give most of the credit to the editors. Those stick figures are crazy funny. Uncle Sam, Fred, Frank, keep it up. You got it. No problem. And I had a question the other day. Someone asked me who does my whiteboards for me. And I don't think they realize that I draw all that stuff myself. I'm like, who do you think I could possibly hire to be a worse artist than I am, drawing stick figures and whatnot? But I'm really glad to hear that you're enjoying it and you enjoy that part of it, because number one, I've got to make it enjoyable for myself. And that's just my personality. I've got the mind of a 12-year-old, as you can tell. So when I'm going through there and I think Uncle Sam needs to be drunk and have a bottle of whiskey, I'm just going to draw him with a bottle of whiskey. But also, I think we're talking about some topics for a lot of people that can be rather dry, although they're vitally important, such as the repo market or quantitative easing or swap lines. That's a good example. And so if I'm able to make it a little more fun to watch, I think more people are going to watch them. More people are going to watch more of the content that really matters. And it's not necessarily what my stick figures aren't really what matters. What matters is that you understand swap lines. And if I can get you to understand swap lines by drawing some stick figures like King FU, and if you didn't see Friday's video, you got to check that out, because I introduced this character named King FU, and he was from the country of FU Fed. But my point is, if I could get someone to watch more of the video and learn more about swap lines by introducing a stick figure called King FU, it serves multiple purposes. Number one, it entertains me. I enjoy it. I think it's funny. Who knows if I'm right or wrong, but probably completely immature, and I realize that. But it hopefully helps people better understand these complex topics that they need to understand to be better prepared for the future and to make better decisions for themselves and their family from a financial standpoint. Ely, thank you for the super chat. Thanks for all your videos you pump out. Can you compare Luke and Brent's theories? Big points where they disagree and agree. They basically agree on everything except for the government response to the problem. And I don't want to put words in Luke's mouth or in Brent's mouth. So I would suggest watching my most recent videos with both of them and kind of juxtaposing the two. But that's kind of my takeaway. Luke thinks that the government will just do anything, and they will print limitless money. They'll do MMT. They'll shoot the money directly into people's checking accounts. They'll give everyone 10 grand, 100 grand, whatever they need to do to paper over or try to paper over this problem. Where Brent thinks there's going to be a line in the sand that the politicians are I'm not going to say they're not willing to cross, but they're unable to cross. And I think that's kind of where their opinions diverge. But let's remember, long term, they're both dollar bears. Both dollar bears. It's just, if you ask them where's the dollar going to be in 10 years, they're both going to say down. It's just a matter of how we get from A to B. KP Singh, thank you for the super chats or super chat. Which gold miners would you invest in nowadays? What is your take on GDX, GDXJ? Is Newmont pricey? Are you still hanging in there? Are you still hanging on to Shell for the long haul? Okay, so as far as specific miners, I haven't had time to dive into that. I like gold from a fundamental standpoint. I understand that the miners are super cheap. So I went in and just bought back, I don't know when it was in March, but when we were at not at the absolute lows, but when we were close to those lows, I went in and just bought the GDXJ because it was part of the speculative side of my portfolio. And I thought it was just cheap. I didn't have time to look at the individual names. And so I just bought the broad ETF. Not that I'm saying that's a good idea. I'm not a big fan of ETFs, but that's all I had time to do. And so now I need to go back and research to find out which companies I want to be in more long term. And that's a great source of the research letter, whether it's Marin or Chris's letter or whatever letter you subscribe to. If you have a resource newsletter that you read every month, that's how I would leverage that information. Not to say that if they say Newmont is a buy, I just say, okay, I don't need to do anything else. Newmont's a buy. My guru said Newmont, so I'm going to buy Newmont. I'm not saying that. I'm saying if your guru or whatever newsletter writer says buy Newmont, I'm going to ask myself, okay, that's interesting, but why? Why are they saying that? Okay, let me read on further. Okay, do I agree with that? Do I disagree? Okay, I see where they're coming from, but let me look at their balance sheet myself. Let me look at their P&L. Let me determine if I think this is a good investment and why. and let me do my own research. They're just giving me the suggestion, just like an employee. The employee is coming to me with the suggestion, but then it's up to me to take that information, process it, do further research, and then make a decision. So as far as Shell, absolutely I'm hanging on. In fact, I'm so excited to see the price go down. When they slashed their dividend, I was like, yes, finally, something's bringing the price back down. Because I want to buy it at like 19, 20, where it got to in March. I think I bought it. I don't know where I bought it, but I was up, I don't know, 10, 15, 20% on it. So I'm really excited to see them slash their dividend and the price to come down, because I don't care if they don't pay a dividend for a year or two. If I'm going to keep the company for 20 years, I could care less. If I can get a 10 or 12% dividend for 18 of the 20 years I own the stock, and I can buy it when oil is at negative $40 a barrel, I'm all in. One thing I'm thinking about doing, and I am not, this is not investment advice. I would not suggest doing this at all, but I've been thinking about it, is when I do buy more, hopefully if the price comes down even further, Shell, I'm thinking about shorting USO. So you short USO and you go long the producers, whichever producer you like. So I kind of, if you guys watch my video, you know I'm not a big fan of USO because they don't buy oil. It's not the underlying asset. The underlying asset is a futures contract, and if the futures curve is in contango, they're having to roll over that contract every single month and realize those losses. It's almost, if the curve stays in contango, they're almost guaranteed to lose money. So I think but so many retail investors have piled into USO for the wrong reasons. I think it's kind of an interesting opportunity to maybe short USO while you're going long the producers. I'm not saying do that. I'm not saying I'm doing that. It's just something that crossed my mind the other day and I was doing a little research on. Okay, it's Joseph from KC. Thank you for the super chat. What's your thought on Warren Buffett holding huge amounts of cash? Should other investors with cash follow his example right now? Warren Buffett's a smart guy. That is for sure. And you got to look at what Warren Buffett does and not what he says. A lot of times those are two completely opposite extremes. So if he's holding cash, it's just like the newsletter. It's just like the research. Just because Warren Buffett is holding cash, it's not a catalyst for me saying, oh my gosh, Warren Buffett's doing it. He's suggesting that. Well, I've got to be all in cash. No, it's just a reason for me to think about, okay, Warren Buffett is all in cash. Why? Why is he all in cash? Let me try to figure that out. Let me do the research on my own. Let me pull up some charts. Let me look at the market cap to GDP, the Buffett indicator. What is he seeing there? And if he's in cash, how much cash? And how does his portfolio currently, as far as a percentage of cash, compare to where it was in the 1980s or the 1990s or the dot-com bust or the dot-com bubble? How is it different? How is it similar? And what lessons can I learn from what Warren Buffett is doing? How can I understand his thought process? And then I would layer that over my own kind of base case and my own framework for my portfolio. You see the difference there? And that's what I do. And I'd really, and not that I'm right or wrong or anything special, but I think that's the smartest way to approach it. Silvio, thank you for the super chat. Quick question. Do you think that the Fed will adopt UBI as a solution instead of debt jubilee? UBI can be used to pay existing credit. So this is like a Steve Keen type of option, which I think is really interesting. I mean, Steve is a smart dude. And if you're not following Steve, make sure you do. Go to his Patreon page. He's got a ton of great information there. I mean, the quick answer is yes. I don't know if the Fed will do it or the Treasury will do it, and the Fed will just monetize the debt. But I definitely think UBI is in the future. Whatever form it is, maybe for the next 6 months, they're giving everyone $2,000 a month. Or I think the bottom line is, in the future, the payments going to the government or going from the government to individuals is going to increase. Whether those payments are through UBI, unemployment benefits, whatever you want to call it, helicopter money, there's going to be a lot more money going from the government to the individual people. I'm not saying that's good. I'm not saying it's bad. There's, like Thomas Sowell says, there are no solutions. There are only alternatives. So we have to look at the cost benefit and see how that might play out. My opinion is there's no free lunch. So if you're giving people money, just printing it up out of nowhere and giving it to them, there's going to be a negative effect to that will counterbalance the positive effect of the original intention. And quite often, the negative can have a greater impact than the positive that you had from giving the individuals the money in the first place. But again, my point is, I do see that being part of the future. Oh, here we go. Great. We got a clarification from Dave. To clarify, my question was, why does Berkshire have to pay policyholders if interest rates go negative? Yeah, so you were talking about insurance companies. I would have to think that through, Dave. That makes sense because you're paying an insurance company. I don't know that they're talking about car insurance. I think they're probably talking about maybe they're annuities. Because although they are paying you back, let's see, I would have to think through that. And I'd have to figure out how those annuities are structured. If they're structured as debt to, I'm going off on a tangent here. I would have to look into that. In fact, I'm going to do that, and that could be a very interesting video. So let me see the videos I'm doing. I got Mondays done. Wednesdays will probably be Robert. Probably Friday, I might be able to dive into that on an actual whiteboard video because I'm actually curious. It makes sense to me that would happen with negative interest rates because it gets so crazy. The whole entire banking system, the whole entire insurance business, the pension fund, everything gets turned upside down with negative interest rates. But how it affects his companies and his insurance companies, which Geico, directly, I got to dive into that deeper. Tracy, thank you for the super chat. Boeing raises 25 million. Oh, probably 25, maybe billion. I don't think they raised 25 million by selling 40-year bonds. You think Mnuchin will use this approach to push the century bond treasury liquidity band-aid? Will this indirectly put more risk on pension funds? Oh, yeah, because you got to look at the duration risk, Tracy, on bonds. So I got to get to this interview quick here. So With bonds, Tracy, you've got something called duration risk, which isn't the risk of holding something to maturity. That's different. Duration risk is if you've got two bonds, one matures in 10 years, let's say, and the other matures in 30 years. If interest rates go up or down by, let's say, 1%, it affects the price of the longer maturity bond greater. That's what they call duration risk. So when you have these longer maturing bonds, like a century bond, if interest rates go up 1 or 2%, I mean, you're going to get crushed on the price if you're someone that needs to sell that, assuming you at some point you would, because I doubt you're going to be holding onto the bond for 100 years. Maybe, I don't know, but maybe you pass it down to your kids or something like that. But and also think about that, the inflation risk that you're taking with a century bond. I mean, what? Look at a chart of inflation in the United States going back to 1920 for the last 100 years. I mean, you want to take that inflation risk to where you're getting paid back with cheaper dollars? You think we're going to have deflation for the next 100 years? I mean, that's just craziness. But yeah, if they give a little bit higher interest rates, sure, it'll probably dupe some pension funds into going in there, because that could be their short-term salvation in order to get that 7% that they need. But keep in mind, the pension funds are in such deep holes that they've got to make a lot more than 7% now just to make up the big funding gap. So yeah, I mean, I think anything's possible. I think the U.S. could sell 100-year treasuries, and I think I don't know that it would be a liquidity band-aid, but it could be a band-aid for the pension funds, the insurance companies, et cetera, that need to get a specific return. But it takes them so far out on the risk curve that at some point the piper is going to have to be paid. Oh, geez. Okay, so there's no way I can get to the rest of the super chats. I've got to get on this interview with Eric. So, guys, what I'm going to do, Sebastian, just please make a note that the last question I answered was Tracy. So the next question I need to answer is Jose Aguilera. And for everyone else, if you didn't hear me answer your question, what I'm going to do, as soon as I get done with my interview with Eric, I'm going to go right to YouTube and I'm going to record myself answering all of the rest of the questions. And this afternoon, I'm going to upload that to YouTube. So just to the channel, I'll call it like Super Chat Questions Answered, and then the date today. And so make sure you go there, and at the latest by tonight, I'll have that uploaded so you can see your question answered. And just as a reminder, guys, if you're interested in KATUSA's research, make sure you check out the link in the description. I'll have Sebastian put it in there. I think we also have it on our website at georgegammon.com, the recommended resources, the newsletter tab. And if you're in the market for a resource newsletter, I think you should check it out. If you're not, it's probably not right for you. But even if you do subscribe to KATUSA's deal or any research letter out there, make sure that you're seeing it from a standpoint of that research letter being your employee and not some guru that you take everything that they say as written in stone and as the gospel. I think that's the best advice I can give to you. So, guys, thanks for all the super chats. And again, make sure you check out the super chats that I didn't get to on a video tonight for YouTube. And I got to fly. I got to get to Eric. I'm running late. So, guys, have a good one. We'll see you on the next video.